This is Jay Martin.
All right, welcome back to the Jay Martin Show. I'm here with Danielle DiMartino booth. It's great to see you again. Thanks so much for coming back on.
It's fabulous to be here. Good to see you.
Okay, so let's start right here. I want to get your take high level on inflation forecast, and maybe let's come at it like this, right? There's still a bit of a debate about transitory versus long term, and I think we get lost in the definitions of those. But if somebody were to come to you today, Danielle, and say, look, yes, inflation's running super hot, but that's still largely a consequence of all the supply chain bottlenecks. The Fed's going to tighten, get this under control. When they do, they'll loosen up a little bit and things will return to normal. And maybe we'll get back to another 40-year bull cycle in the bond market. What do you have to say to somebody like that?
Well, there are no hard and fast rules that exist any longer, period, end. They just don't exist. And I think people should appreciate several changes that have taken place. When it comes to what's similar to the past, it's that recessions, and we are in a recession. I don't think anybody doubts we're in recession. Where I am here in Marshall County, Indiana, is a hotbed of manufacturing activity in the country. And they have just closed 3 factories here. There's no more supply chain disruption. They've laid off 650 people. This is a phenomenon that we're seeing. We're seeing it across industries. It started off as simply being, oh, it's a Silicon Valley startup phenomena. They threw too much money, venture capital threw too much money at these unicorns, and all this is just kind of unwinding. Those are not the kind of layoffs that we're seeing today. We're seeing across the board, across industries, across manufacturing, across services, layoffs. And just in speaking to business owners, they're saying, even our wealthy clients have begun to pull back in terms of what they'll spend. So to answer one part of your question, the part of inflation that will go and act like a traditional inflation would is going to be the discretionary inflation that's coming tumbling down. Whether you're talking about car rental rates, car prices, new car prices, they're holding the line, which I think this is one of the biggest gambles that the big place ever made, is trying to hold the line on these new car prices. Good luck is what I have to say to them.
Interesting.
Used car prices are coming down. The auto repossessions are ramping up to 15,000 on average a day. We'll get there this year. That is a bloody number. And so to traditional layoffs, traditional recession, anything that you don't absolutely need, the roof over your head, the food in your refrigerator and in your pantry, the electricity, and fuel. Everything else is up for some serious disinflationary pressure. Now, I'll get to the final wrinkle. There's a sticky phenomena in the data, right? Redfin told us that they've been keeping these records since 2012. 21% of U.S. Cities right now are seeing escalating levels of individuals cutting the prices of their homes. So the highest number that they've seen, more than a fifth. We suspect that number is going to really broaden out, and that home prices are actually going to turn negative in 2023. Hard to believe, but we've got 11 months supply of new homes for sale in America. And at the beginning of the year, we were still talking, at the beginning of 2022, we were still talking about an undersupply of homes.
Yeah.
It goes to show you how quickly the narrative can change. However, I'm going to caveat what I just said. Fannie Mae's done some great work. On average, it takes about 5 quarters for high home prices to percolate, make their way through into the CPI. Okay? 5 quarters is a long time when things are changing as quickly as they are. And because we have this single family rental phenomena, which we have not had in the past to the extent that we do, millions more Americans today are renting a single family home than going into the last major recession, 06, 07.
Yeah.
These individuals, these companies have chosen lower occupancy rates in order to hold up the rental rate, which is above market price.
Yeah.
So a good friend of mine, Ivy Zellman, world's preeminent expert on housing, she anticipates that we could get up to, in the fall, because rentals are coming down so slowly, even as quickly as housing is collapsing, residential to purchase, she anticipates that we could see the level go from nearly 6% year over year to 7% year over year in the CPI. That's 40% of the CPI's weight. So you could have deflation, disinflation on your discretionary side, and you still have your housing going up in the inflation data for months to come. That's problematic for Jay Powell. Highly problematic for Jay Powell. I'll add one more wrinkle, because you asked me a big question. You asked me about a 40-year bond bull market in the bond market. Well, we're seeing record percentages of companies talking about onshoring, reshoring, friendshoring. It's true. It's true. We learned that we need face masks of our own. We learned that we need our own pharmaceutical industry. We learned that having 25% of auto parts come from China might not have been the best idea when the pandemic hit. Heck, when the trade war started. So we've learned a few lessons. Companies they're aware of this need to onshore. That's great. But it also will structurally increase your inflation. It will put you at a higher general level of price increases just because it's simply not that cheap to produce in America. It is what it is. But I think that there are going to be enough industries that go that way that you are going to see some permanently higher inflation rates in the data. Okay, so that was one question, and I took forever to answer it, but it's not an easy answer right now.
No, and I appreciate that. I made a ton of notes, and I want to pull in a few threads there. I thought it was a great answer. So just to recap some of what I heard from your perspective, you're expecting maybe inflation to calm down in the discretionary spending. So the things we don't really need. You mentioned the auto sector and the various compartments within that as a great example, but the necessities, right? Our food and our fuel, right? Those are still projected to be high. I don't see any reason that would be wrong when you look at just basic macro geopolitical factors. The supply of these goods are just being constrained and controlled and protected more than I've ever seen in my life. Now, you mentioned that the record reshoring among American corporations, and this is inevitably going to bring prices up. If globalization brings prices down, then deglobalization would have the opposite effect. But in real time, where you're at, right, you're seeing manufacturing shut down, right, in Indiana. You spoke about that. And so is there a delayed action here where we're seeing reshoring occur, but this may take 5-10 years before these jobs come back?
No. Reshoring takes a very long time.
Okay.
The process is these are long investment cycles. None of this is going to be seen in the current recessionary data. None of it. And the risk is that if this recession is as prolonged as I think it is, and my litmus test for that is that people who are in the business of repossessing cars, if they were expecting a short and shallow recession, they would typically lease extra overage lots just to get through the recession. Because they've got a little bit, they've got more cars on hand than they would normally have on hand in terms of repossessed vehicles. They're buying the land.
Interesting.
They think it's going to be that long and these are not economists and these are not politicians. These are just simply people who are saying, wow, I've never seen this volume of repossessed cars in my life.
So they're buying the land to store the cars they anticipate will be repossessed and they'll be sitting on the inventory. Did I understand that? Yeah.
It's going to take a long time to auction these cars off. And there is a lot of resistance on the part of the lenders who made the loans, as well as the dealers who have taken in trade-in cars at too high a level. Yeah. So everybody's upside down right now. They're trying to get a certain amount and not recognize these losses. So it's going to take, at some point, a regulator is going to tap on the shoulder of a lender and say, get rid of these bad loans.
Yeah.
Do it now.
Right.
And then you're going to see a pocket.
Got it.
But we are seeing Manheim's prices come down very quickly, and used car prices were the largest driver of the CPI.
That's right.
During the pandemic.
Yeah, that's right. That's right. Okay, now the one bucket that was kind of a question mark in my mind in the necessary expenses was shelter, right? You spoke about housing. We expect food and fuel to continue being quite inflated. I agree. Shelter is the big question in my mind, and you spoke about that and the delayed response in the CPI numbers. So to recap, you're seeing, and we're seeing the hottest markets in the United States right now start to crash. We spoke about Austin before I hit record. I'm seeing the same thing in Boise, Idaho, a super hot market during the pandemic. Now it's just in free fall. Same thing in Coeur d'Alene. All these little COVID hot pockets are now coming back to reality. And what that's creating where I live in Pacific Northwest near Vancouver, British Columbia, is a super hot rental market. You know, as rates increase, housing prices are falling, people are less inclined to buy, increasing the percentage of renters. And I think you touched on that a little bit. And so how does shelter factor into this inflation disinflation narrative if long-term or medium-term, you define that time horizon, we're expecting prices to come down?
Well, again, even if prices do start to come down, and we have 83% of US home builders are discounting new homes right now. That's a huge, massive number.
Right.
New homes. Of course, new home sales are only about 10% of the market. So the majority of your housing market is existing home sales, but that is coming down very rapidly as well as sellers begin to capitulate and realize, you know what? A year ago, I could have played the greed game. That window closed. If I really want to sell this house, I need to sell it at whatever price the buyer wants and get out. But nonetheless, again, there is a massive lag where we're not going to see this. I'll put a caveat on a caveat. Leases are 12 months or 6 months in some cases, but they're at least 6 months.
Mm-hmm.
So that's another element that makes rental inflation very sticky. But there are 1 million units coming online in the United States in the next 12 months, 1 million rental units. We're talking mostly about apartments here, but we are going to, the narrative is going to violently shift in the next 12 months as we've got more homes under construction than we have since 1973. When by the way, the baby boomers were growing at 4 times the rate millennials are growing. Boy, do I make huge enemies on my Twitter feed because people always look at the stock of population.
Okay.
And they say the National Association of Realtors, world's biggest lobby, says that we're 6 million houses shy. We got this massive deficit. Well, the National Association of Realtors is not factoring in the growth of the population, which is the only thing that matters. If the population's not growing, it doesn't matter that it's a large demographic, that the millennials are large. They're growing at 1/4 the rate millennials were growing at back in the 70s when they were hitting their prime earning years and the time of their lives to buy homes. And yet we're constructing more new homes in America than we were since 1973. And the multifamily pipeline apartments, 1 million units coming online in the next 12 months. That's enormous as well. So we are, believe it or not, especially as people who can't even afford to rent. Some people, I was just talking to a lady who does hair. You know, her son is living on a friend's couch in Indianapolis because he can't find a 1-bedroom for his budget, which is like $1,400. There's a lot of room, a lot of people being roommates these days, a lot.
Yeah.
Once you save that money, once you learn how to, grow accustomed to being a roommate, are you ever going to say, you know what, today's Wednesday. I feel like it's a good day to double my overhead. I'm going to go off and live in my own apartment.
Yeah.
That's going to take some time. And we've also got baby boomers building out their basements right now to be ensuite apartments. So they have their own little kitchenette, they have their own little, and they're sending their kids upstairs
for their kid. Yeah.
The main house and saying, it's time for grandchildren. You're never going to afford to save to pay a down payment. You've been paying stupid rental prices all this time. So you haven't been able to have the budgetary ability to save 20% for a down payment. So we're going to have a lot. It's the Italianification of the U.S. housing market. And people just don't understand that this could be a very long, drawn out down cycle.
Hold on. What was the word you said? The whatification of the housing market?
The Italianification.
Explain that.
Italians, the country of Italy has culturally always had multiple generations under one roof.
Yes.
That is simply it's just a way of life. the nona takes care of the grandkids, and mom and dad can go off to work. Well, guess what? Childcare in America is prohibitively expensive now because we paid so many people to not work. They were making double and triple what they were making before in childcare, in nursing homes, in home health aid, as busboys, as waitresses. So, but what you do is you adapt, and many American families have adapted by becoming a little bit more like an Italian.
Interesting. Okay. I mean, so yeah, what you just said to me, honestly, I love that term, the Italianification. Because honestly, it just sounds smart. Like I was just sharing, I got 3 young kids.
Yeah.
It does take a village to raise these children, and my parents and my in-laws are not close. They're not in the city. One set's not even in the country. And so there's massive distance. And to replace that traditional grandparent role, we outsource to a nanny. That's money out of pocket, right? In addition, our housing price, their housing price, we've tripled our living expenses unnecessarily just due to like this desire of independence and comfort. But it's maybe not so pragmatic when you think about it.
No, it's not. And in fact, Lennar, which is a publicly traded home builder in the United States, Lennar has actually introduced a new build. And it is a build that they build specifically for 2 generations living in one house.
Interesting.
And it's taking off. Look, I think there's a certain very sad irony about the timing of recession. And that is that if you look at job openings right now, they're coming down very quickly, not with the JOLTS data, which has many flaws. We've done huge analysis on it. Not with the JOLTS data, but with real-time weekly job openings data, we're seeing it come down very quickly, even for jobs with minimum skills. And that was where we had the deficit throughout the pandemic. So here's the irony. We finally are at the juncture, because the last check Uncle Sam wrote to people who had dropped out of the workforce was their income tax refund. That money's been gone through April of this year, which happens to be when the economy hit a wall. It's the last time the government sent out, because unemployment benefits, supplemental unemployment benefits were not taxed. So income tax refund season's the real last cash infusion that we've had. Now that we've got kids back in school, I say that we're going to have an influx of women back into the labor force with school-aged children, because they finally can come back to work. The question is, and here's the sad irony, are the jobs going to be there?
Right.
Or are they finally able to rejoin the workforce since the pandemic hit? Because there's no more benefits from the government. Inflation's eaten them alive. They couldn't afford childcare. So they're going to go back to being a double earning family, mom and dad. And then the job's not there. I mean, that's the irony right now. And one of the reasons I think, again, that this recession is going to be as prolonged as I do.
That's an interesting angle. I hadn't thought about that. Okay, now let's talk about, where do you go here, right? So we covered a lot of volatility, right, in some really important sectors, and probably forecasted increasing inflation in the real necessities that you require to live your life, food and fuel being the 2 biggest ones. Where do people go to protect their wealth right now? Say you've been a traditional equities, the 60-40 portfolio, that's been your gig. And you're thinking about the next 40 years of your life, 20 years, whatever your time horizon is. What strikes you as an intelligent place for capital right now, Danielle?
It is an extremely difficult environment right now to invest. It really is, because correlations have risen so much that it's very difficult to find places to hide. So, some of the best money managers in the world are sitting on record levels of cash, and that's with good reason. All of this being said, there are strong cash flow companies out there. I don't look for companies with strong earnings, because they've lowered the bar so much, and now they're beating their estimates by just a hair. So don't listen to the bubbleheads on Bubble Vision and just take them for their word. So, yeah. But strong cash flow companies, that's a different proposition. And that means that they're going to be able to continue paying you a dividend to the extent that you want to be exposed to the stock market. You want companies that are going to be able to continue paying the dividend, which will help make up for any decline in the stock price. help offset that. And there are also places out in the Midwest, where I am in Indiana, where the state's public pension is very well run. You wouldn't think that they were literally shared a border with the state of Illinois, where there's like a mushroom cloud over its public pension. But I think that certain good credit states, municipal bonds, depending on your tax bracket, are a great place to be. You just have to find a really good manager to buy them individually. I'm not suggesting buying a bond fund filled with municipals, because inevitably you'll have a New Jersey or an Illinois in there because some bond fund manager is trying to get a higher yield when public pensions have just had their worst quarter ever.
Right.
And then I'm not convinced that, let me put it this way. I understand it's been a frustrating place to be. I get it, but I'm not getting rid of my gold, because if things are going to get as bad as I think they're going to get, and inflation is going to be stubbornly high, then I think that precious metals will be a safe place after the margin calls come.
Interesting. I mean, you're making my audience excited with that statement, that's for sure. Now, it's interesting that you say that, because where I'm looking right now is dividend paying gold companies, right? And I like the royalty model because of their insurance, or I guess insulation against some inflationary pressures, which is interesting to me. I just got to say though, what you just shared, right? Look for yield in the market, right? Everything that we've covered today seems to me like we're coming back to a place of sanity, right? Maybe stop speculating in the broad equities market. Look for companies that actually generate yield. Maybe in terms of the housing conversation, right? Coming back to a multi-generational household just seems like common sense to me, right? This deglobalization trend, it's like maybe in Squamish in the Pacific Northwest where I live, I shouldn't have access to a ripe mango in January. Maybe that's not a realistic expectation. And all of these factors that we've discussed are kind of like a return to some semblance of normal and sanity, and more just a realistic expectation about what life should be. What do you think about that?
Yeah. And you know what, Jay, to add to that, on a cultural level, on a cultural societal level, we've become a world where there are many enemies, enemies of the people, enemies of the state, very angry people. But we also, after the pandemic, grew to appreciate our family members so much more than we had before.
Yeah.
And so we're at a crossroads as a society where it makes sense to actually consider having multiple generations under one roof, because now we all have a greater appreciation across generations for the importance of our families. So that has nothing to do with the economy or the markets, but I had to throw that out there.
All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.